$7 a week doesn't feel like a decision. It feels like nothing. It's a coffee, a quick snack, something you buy without thinking and forget even faster. But what if that exact same $7, the one you won't even remember spending, could turn into something you would notice? Something like $2,000 showing up in your account every single month. That's not a hypothetical. That's the question John asked himself. Because like most people, John wasn't struggling. He paid his bills, covered his rent, had a little left at the end of each month, not broke, just stuck. Every time he looked into investing, the numbers felt unrealistic. $500 a month, $1,000 to get started. It all felt like it was designed for someone else, someone earning more, someone further ahead. So he closed the tab, not once, every time, because the starting line never made sense for his reality. But then something changed. What if the starting line wasn't $500 a month? What if it wasn't $1,000 up front? What if it was just $7 a week, not $7 a day? 7 a week, about $1 a day, around $30 a month. Now here's the problem. On its own, $7 a week is not life-changing. It doesn't feel powerful. It doesn't look impressive. So how does something that small become something that big? This is where everything shifts, because the answer is not in the amount. It's in the system behind it, and that system is compounding. Now, most people hear that word and skip past it because it sounds technical, complicated, something reserved for experts. But the truth is, it's one of the simplest ideas in all of investing. And once you see it clearly, you can't unsee it. Let's break it down. Imagine you invest $100 into a stock priced at $10. That gives you 10 shares. Now this stock pays a 5% dividend. That means every year you get paid $0.50 per share just for holding it. Year one, you own 10 shares, so you earn $5. Most people would take that money, spend it, forget about it. But John doesn't. He reinvests it. That $5 buys him half a share. Now he owns 10.5 shares. He didn't add any money. The investment did it. Year two, that same 5% is now paid on 10.5 shares. So he earns $5.25, reinvests again. Now he owns over 11 shares. Year three, the process repeats. More shares, more income, more growth. And here's the key. At no point did John add more money. The money created more money, and then that money created even more. That's compounding. Now imagine that happening not with $100, but with $7 a week across multiple investments over years. That's when things start to change. But before John moves forward, he asks one important question. Why not just pick one stock? Why split $7 into multiple pieces? Wouldn't putting everything into the best stock give the best result? And on the surface, that sounds logical. But here's what he realizes. One company can fail. One company can cut its dividend. One company can have a bad year or face something nobody saw coming. And if all your money's in that one place, everything breaks with it. So instead, John chooses something different. Not one perfect pick, but a system that still works, even when one part doesn't. And that's where the real strategy begins. Because this isn't just about investing $7 a week. It's about building something that can survive long enough to grow into something meaningful. And in the next part, you'll see exactly how that system is built. Now, John understands compounding. He understands that small money can grow, but he still doesn't have a plan, because knowing that something works is very different from knowing what to actually buy. And this is where most people get stuck again. They jump from one idea to another. They chase trending stocks. They follow headlines. And in the end, they build nothing. So John does something different. He builds a structure, not random picks, not guesses, a system where every piece has a purpose. And it starts with something called a core and satellite strategy. The idea is simple. The core is your foundation. Stable, diversified, reliable, something you don't need to constantly manage. The satellites are everything around it. Each one has a specific role. Each one adds something the core cannot. And together, they turn a simple portfolio into something powerful. So John starts with the core. He's not looking for something exciting. He's looking for something that covers everything. The entire market, multiple sectors, hundreds of companies, all in one place. That's how he finds SCHD. An ETF, which means instead of buying one company, John is buying over 100 dividend-paying companies in a single move. Healthcare, energy, financials, consumer goods, all of it bundled together. No need to analyze each company individually. No need to worry about picking the wrong one because SCHD already does that work. And the numbers support it. A solid dividend yield, a strong dividend growth rate, meaning the income doesn't just exist, it increases every year. Automatically, that's why SCHD becomes the foundation, the piece that everything else is built on. But John isn't done, because a strong foundation alone doesn't maximize growth. So now he looks for his first satellite, something more aggressive, something that pushes income higher over time. And that's where Lowe's comes in. Most people recognize the name. It's one of the largest home improvement retailers. People go there to fix things, upgrade their homes, replace appliances. And here's what makes that powerful. That demand never disappears, no matter the economy. People continue to spend on their homes, but that's not what caught John's attention. It's the dividend history. Over 50 consecutive years, Lowe's has increased what it pays investors. That's consistency. That's reliability. And right now, that growth rate is aggressive, much higher than SCHD. The yield starts smaller, but over time, it grows faster. And that's exactly what John wants. Something that starts small, but becomes significant later. Now he has two pieces, a stable core and a fast-growing satellite. But something is still missing, because both of these perform best when the market is doing well. So John asked the next question. What happens when the market isn't? What happens during a crash, a recession, a year where everything is falling? He needs something that doesn't depend on good conditions, something that continues to perform, even when everything else struggles. That's where NextEra Energy comes in, a utility company, which means one simple thing. People pay their electricity bills no matter what. Recession, crisis, pandemic, it doesn't matter. The lights stay on, and that creates stability. NextEra doesn't need a booming economy. It just needs people to keep living their lives, which they always do. That's why it becomes the defensive layer. Not the fastest grower, not the most exciting, but the one that keeps paying when everything else slows down. Now the portfolio starts to feel complete, but John isn't finished yet, because he wants something else. A stock that does both growth and income at the same time. And in the next part, you'll see how he adds that and why one final pick changes everything. At this point, John has something solid, a foundation that covers the market, a stock that grows income aggressively, and a defensive layer that holds steady when everything else doesn't. But there's still a gap, because so far, each piece does one job. Now he wants something that does two. He wants a stock that grows in value while also increasing the income it pays him. Not one or the other, both. That's where Goldman Sachs comes in. Now, this isn't a small company trying to prove itself. This is one of the most established financial institutions in the world. They make money from trading, managing assets, advising corporations, and handling massive amounts of capital. And more importantly, they've been doing it for over a century, through wars, through financial crises, through economic cycles most companies never survive. That history matters because it shows resilience. But what really stands out is the combination. Goldman doesn't just grow, it pays. And it increases what it pays at a pace that rivals some of the fastest growing companies in the market. So now John has something different. Not just a contributor, but a multiplier. A stock that pushes both sides of the equation forward, portfolio value and income, and that balance is powerful. But there's still one final piece missing, and it's the one most people overlook, because everything so far feels familiar. Big names, well-known companies, the kind of stocks you see everywhere. But sometimes the biggest opportunity is where nobody is looking. That's where John finds his fifth pick. Federal Agricultural Mortgage, ticker AGM. And at first, it doesn't stand out. It's not trending. It's not talked about. It doesn't show up in most portfolios, which is exactly why it's easy to ignore. But then John looks deeper. This company finances agriculture, farms, land, rural infrastructure, the backbone of an entire industry that never disappears. Because no matter what happens in the economy, food still needs to be produced, and that creates demand. Stable, consistent, long-term demand. Now, here's where things change. When John looks at the numbers, AGM leads. Higher dividend yield than anything else in the portfolio. Faster dividend growth than anything else in the portfolio. Strong appreciation on top of it. Every metric that matters, it dominates. And suddenly, what looked like an unknown pick becomes one of the most important pieces because it fills a gap. A part of the market most investors never touch. Now the structure is complete. 5 positions, each one with a clear role. SCHD, the foundation. Lowe's aggressive dividend growth. Next era defense. Goldman Sachs, dual growth and income. AGM, high yield, high growth, overlooked opportunity. No overlap, no randomness, just a system. And here's where it gets interesting. John doesn't invest large amounts into each one. He splits his $7 equally in 40 per week into each stock. That's it. No big capital. No large upfront investment. Just consistency. And when all 5 work together, something starts to happen. The portfolio blends into something bigger than each individual piece. A combined dividend yield, a strong growth rate, and steady appreciation. But numbers on paper don't tell the full story, because what matters is what happens over time. And in the next part, you'll see exactly what the $7 a week turns into, because this is where small becomes significant. Now we move from structure to results, because this is the moment everything becomes real. Not ideas, not theory, but actual numbers over time. And this is where expectations need to shift, because if you're expecting something dramatic in the first year, you'll miss what's actually happening. Let's start there. After year 1, John's portfolio is worth about $364. That's almost exactly what he put in. Nothing exciting, nothing impressive. And for most people, this is where doubt begins, because it feels like nothing is working. But that's the illusion, because compounding doesn't show up early. It builds quietly, in the background, where you don't notice it. Year 1 is not where the result is. It's where the process begins. Now fast forward to year 10, something changes. The portfolio grows to around $7,613. Still not life-changing, but now it's more than double what John actually invested. And this is where momentum starts, because the growth is no longer just coming from his $7 per week. It's coming from the portfolio itself, generating, reinvesting, growing. Then comes year 20. And this is where things start to feel different. The portfolio reaches approximately $45,995. Now it's real. John has invested less than $8,000 of his own money, and the portfolio is worth nearly 6 times that. This is where most people finally understand what's happening, because now the growth is visible. Now it feels meaningful. But here's the truth. The most powerful part is still ahead, because compounding doesn't grow steadily. It accelerates. And that leads to year 30, where everything separates. John's portfolio reaches around $311,553 from just $7 a week. Now pause for a moment, because this is where most people misunderstand the outcome. They see the number, but they don't see what created it. John didn't invest $300,000. He invested about $10,920 total across 30 years. That's it. Everything else came from the system, from growth, from reinvested dividends, from time. Now here's where it becomes even more powerful. That portfolio doesn't just exist. It pays around $25,000 per year in dividends, which breaks down to roughly $2,100 every single month. Income, passive, consistent, built from something that once felt insignificant, even a week. And here's the breakdown that matters. A large portion of that growth came from the stocks increasing in value, but a massive portion also came from dividends being reinvested, doing exactly what we talked about earlier. Money making money, then that money making even more over and over again for decades. And this is the part most people miss. It's not about finding something extraordinary. It's about letting something ordinary run long enough to become extraordinary. But now there's one final piece, because knowing the outcome is not the same as achieving it. And in the last part, we bring everything together. What actually matters, what most people get wrong, and the one decision that determines whether this works for you or not. At this point, you've seen everything. The starting point, the system, the structure, and the outcome from $7 a week to over $300,000, paying more than $2,000 a month. But here's the part that matters most. None of it happens unless you start, because the biggest mistake isn't choosing the wrong stock. It's never beginning at all. Most people don't fail because they lack information. They fail because they hesitate. They wait for more money. They wait for the perfect moment. They wait until they feel ready. And while they're waiting, time keeps moving. Because here's the truth, most people avoid. You don't need more money to start. You need a decision. Because $7 a week is not a financial barrier. It's a mindset barrier. It's choosing to do something small instead of nothing. And that small decision, repeated over time, becomes something powerful. Now let's make this simple. If you want to follow this exact path, there are only 3 things you need to do. First, open a brokerage account. This is where your investments live. It's not complicated. It's not restricted. And it doesn't require experience. In a few minutes, you can go from having no access to being fully set up. Second, fund the account. And this is where hesitation usually shows up, because moving money feels like commitment. But remember this, leaving money unused is also a decision, one that guarantees no growth, no progress, no change. So whether it's $7 to or $50, the amount doesn't matter. What matters is that it starts. And third, invest consistently every week without interruption, without overthinking, without trying to time the market, because timing is what keeps most people stuck. They wait for a better price, a safer moment, and they never act. But John didn't do that. He followed a system. He invested the same amount at the same time every week and let time do the rest. Now, here's the most important part. After you start, you don't interfere, because the instinct to check constantly, to react to news, to change your strategy, that's what destroys long-term results. So instead, you follow 3 rules. You hold through the drops, because they will happen. Markets don't move in straight lines, and the only people who lose permanently are the ones who leave. You reinvest everything, every dividend, every return back into the system, because that's what fuels compounding. And you stay consistent, not for weeks, not for months, but for years, because this only works if you give it time, and that's the difference. Not intelligence, not luck, not timing, just consistency. So when you look back at everything, all the numbers, all the projections, all the outcomes, they all come down to one simple question, not is $7 enough, but are you willing to stay long enough for it to matter? Because 30 years from now, there will be 2 types of people, those who started and those who didn't. And everything you've seen in this video only belongs to one of them.